Hey, good morning. Welcome to the Mortgage Rate Forecast with Scott Criss, your mortgage rates and news. It is February 1st, 2018, and let's start with the charts. Dang, this has been hurting us. Mortgage-backed securities currently trading at $100.80 this morning. We're looking at support coming in below us at about $100.70, which is right around here, and another support level all the way down at $100. So we can see that we've consistently been seeing bonds worsen since really you can go back even before January, but we did see some consistency in December, but since the beginning of January, bonds have just been taking a beating. So we're looking at resistance coming up above us now at 101.50 and $100. So here's our first level of resistance, and then $101. So at any rate, we're just kind of struggling, guys. We're kind of struggling. Unemployment numbers came out today. That did not help the bond market. Productivity reports came out, and that was actually wasn't too bad for bonds. But the underlying problem is just overall economic growth. And if you're an investor and you have $10,000 and you're like, okay, well, I could currently put it in the bond market, and that's with inflation and everything else, that might yield me 2%, 3% if I'm lucky. Or I can put it in stocks and maybe I can get 5 or 6% out of it. So as an investor right now, because of how robust our economy is looking, you're probably going to put your money in stocks, not bonds. And that's going to drive down the dollar price of bonds and increase the yields to the investors, which is good for the investors. But it's also increasing interest rates to you as the consumer. So that's really what's going on here. Um, Looking at all the analysts, what they're saying, they're really worried about the jobs report tomorrow. And we could see a significant sell-off tomorrow if the jobs report comes in at what we're kind of anticipating it to come in at, which would again reinforce a robust economy, reinforce potential inflationary factors, reinforce higher stock prices, which is going to put pressure, even more pressure on bonds on top of the government's quantitative easing. They're stopping. They're no longer reinvesting back into the bond market. All of these things are going to drive down the price of bonds and drive up the yields, and of course to you as a consumer, the interest rates. To kind of quantify where we're at right now, if we go back to December's reports, Freddie Mac reported that the consumers receiving a 3.95 interest rate and paying half a point to get that. If we take a look at where bonds were trading in December, we're looking at them trading right around $100. I'm sorry, 102.70. That means they're currently trading about $1.90 worse. So they were trading right around up in here, and then now they're trading all the way down here. So what does that mean? If someone was paying half a point back then, they might be paying almost 2.5 points now for that same rate. So we are definitely starting to see rates go up because most consumers are not going to want to pay that many points to try to get their rate down. So here's the outlook. My last projection, by the way, it was a hit. Bonds came in at 101.51. I was projecting bonds to be trading somewhere between 101.30 and 101.70, so it came in right in the middle, which is good to see. But I believe the forecast is really going to be bearish, and the analysts agree. So I think we're going to continue to see a downward trading range. And from where we're trading at today, I think we're probably, by next Thursday, end up trading between $100.20 and $100.70. So that's a swing of about 10 cents to 60 cents worse than where we're at today. So, what's the consensus here? Unless you're a major gambling man, I would say if it was me and I had an opportunity to lock in my interest rate, I'd probably play it safe and lock it in. Nobody has a crystal ball, but all the factors are really pointing that way right now, guys. Okay, that's it for now. Everything likes to be liked, so does this video. Hit that thumbs up. We'd love to hear from you. What are your thoughts? Do you agree? Do you disagree? We'd love to hear what you think. Leave your comments down below. And if you like what you see here and you want just normal updates, click the little guy on the left. That will get you subscribed, and then you'll get a little alert when we release our new videos, generally every Thursday. And if none of this made sense to you, no stress. If you click on the top right, that will take you to Mortgage Bonds 101. And that will teach you the basics that you need to know when trying to figure out the best time to lock in your interest rate as a consumer. Okay, that's it for now, guys. Have a great week. We'll be on next week. Bye-bye.